good. I guess you guys see my screen, Ross? Can you confirm at least?
Yes, sir. We're good.
Okay. All right. Oh, sorry. Oh. There we go. Okay. So, yeah, guys, I'll give you just a little bit of rundown on CIH to begin here. First of all, thanks for joining us. This should take, somewhere between hopefully 30 and 45 minutes. If we run a little bit longer, a little bit shorter, give or take, it should be right around there. But yeah, CIH is a financial risk management company. We do risk management for agricultural producers and buyers all across the country. We were established in 1999. We have over 600 clients in 15 countries. So like Ross stated, I'm primarily on the cattle beef desk, working with beef producers across the country. But as a company, we have, many different products all across the different industries. So hog, dairy, beef, ethanol, poultry, and we work with some food and snack companies, originators, elevators, feed mills, and then dairy and pork buyers as well. So kind of all throughout, anywhere where there's risk in the ag business, we tackle that. Just to give you a little bit of an overview of what I'm trying to accomplish today on this webinar and kind of give you guys a little insight on is just the market in general. Cattle market's been super volatile, super strong, really historically great prices right now. So give you a little bit of an update on the market in general, talk a little bit about what we're seeing as far as, demands in the cattle market and profitability for producers today. And then, most importantly, want to show you guys the Livestock Risk Protection Program, LRP, and just give you a little bit of an understanding of the program and also how we're looking at it for clients. So to start, we'll look at the just cattle market in general. I felt like I had to adjust this slide a couple of times this week, and I probably should have done it again today. But the cash market in the cattle market has been crazy strong over the last couple of weeks, and really it's been strong over the last 18 months. Over the last few weeks, we've seen this market just continue to increase higher, pushing towards basically all-time highs. Live cattle cash on a 5-area basis right now is 175.87. Depending on where you're located, you might be getting a little bit stronger or right in line with those prices. But for the most part, on a 5-area basis, right there, 175 to 176. You can see the market has increased about $16 since January just this year. And like I mentioned, just in the last couple of weeks, we've gone from roughly $1.65 up to $1.75 to 76. So putting 10 to 12 bucks on the cash in 2 weeks is a pretty nice jump. A lot of people looking back to years like 2014, and you can see on this chart here that light blue line. If you look at the bottom, that far left color from 2014, you can see that's kind of the year a lot of people comparing this year to. Our all-time high in the cash was 171.38 in November of 2014. So kind of taking out those highs here earlier in the year, which is great for producers. As I mentioned, there's a little bit of a divergence between location as far as what the market's trading. This gives you a little bit of an overview. I know there's a lot of numbers here, but basically what you're looking at is volume traded at certain prices. So you can see that in Nebraska, the cash market has increased from 168 to 175, Iowa to 168 to 175. Again, like I said, bear with me a little bit here. Cash market's been kind of skyrocketing higher, so hard to keep up with it with these slides. I know they were trading some cattle today at $1.80 to $1.82 in some spots up in the north. And then in the south, down in Kansas and Texas, trading at a little bit of a discount, so 168 to 171. Again, I know earlier this week they were trading some cattle at as high as $1.75. So just trying to point out that there is a little bit of a differential between the north and the south as far as what the cash market's doing today. Personally, I think it has a little bit to do with grading of cattle. What we've seen is, the select product or the select percentages in the southern plains have really started to increase. Whereas in the north, there's a lot of choice cattle up there, and packers are coming for those cattle more aggressively and paying a little bit of a premium. So definitely seeing those spreads widen out again. Feeder cattle index, again, not a perfect science, just because feeder cattle market is so all over the place, so regional, so location specific, and so price. Just a lot of volatility in the feeder trade. A lot goes into the feeder trade. How much corn do you have available? How much grass do you have available? Are you in a drought area? Just a lot going on here. But the feeder cattle index is a CME index that tracks, for the most part, 8-weight steers across the country. So we use that as kind of a baseline for what cattle are trading for. You can see all the data that goes into that index. So currently you can see the index is 193.24. Again, that index did jump today quite a bit due to a lot of higher volume and a lot of higher prices being traded. You'll kind of find that theme here throughout this whole webinar of, prices keep going up, which is a great thing for producers. And you'll notice, in years like 2014, that index did continue to rally. So although we are really, really high, the potential and what the futures market is showing you today is that there is still, more opportunity in this market. So again, I'll jump into that a little bit when we talk about the insurance side of things and the protection that we're looking at. But right now, you can see obviously the market's off to a hot start, but definitely potential for more. Again, feeder cattle index by state. So just looking at the trade of feeder cattle throughout different areas of the country. If you look in the northern states, there's going to be a little bit more of a premium being built into that trade. Those guys up there have a lot more availability with corn. Corn basis is a little bit more attractive for them. Also just conditions, we've seen a lot of drought conditions in Oklahoma and in the Panhandle, which just kind of slows down cattle in general. Big picture, why is all this happening, right? Why are we seeing these big moves in the market? Why are numbers so tight? Why are feeder cattle so expensive? Why are cash cattle, pushing towards all-time highs? And it's just plain and simple. We've kind of gone through a little bit of a liquidation phase where numbers have tightened. A lot of it has to do with the drought exposure that we've seen over the last couple of years. But you can see here, USDA puts out cattle on feed reports on a monthly basis, typically the third Friday of every month. So we'll actually get another update next Friday. But currently, cattle on feed numbers are down 4.5% year over year. So we're down about 600,000 head year over year, which is our lowest numbers going back to March of 2018. You can see some of the big cattle feeding states, such as Texas, down about 5%, which is a big drop in numbers. So it's just a supply and demand issue going on right now, and the concern is that we continue to run into these tighter numbers. You can see that with placements. So on feed showing what we have on feed today, placement showing cattle that are being placed into the yards on a monthly basis. Placements are also down about 7% year over year. So we continue to see, in this most recent report from February, we actually saw a little bit of an increase in placements down in Texas. But for the most part, cattle on feed across the country being placed into the yard down about 7% year over year, which brings concern going forward for those cattle that are being placed today into the yard coming out in the future. Obviously, that kind of brings a hole into production looking forward. Like I mentioned, drought concerns, we obviously watch that and keep a close eye on that as far as, wheat pasture or any type of grazing grass for cattle, specifically down in the Panhandle there. Drought concerns have cleaned up a little bit in the Corn Belt up in the north, but still there in Oklahoma and Texas, as I'm sure a lot of you guys know, still dealing with a lot of dry conditions. And you can see that in the corn basis. So again, we talked about the cost affecting the price of feeder cattle. If you look at this chart, just gives you a pretty basic overview of what corn basis looks like across the country. So as you work your way into Oklahoma and Texas, that basis, works closer to $2 over. Whereas if you go into some of the sweet spots of the Corn Belt, you're looking at close to an even basis. So from a supply and demand scenario of feed availability for the producers to supply feed needs to these cattle. Down in the South, they're just dealing with higher prices and higher feed costs, which just kind of slows down the aggressive buying when costs are so high. I'm just going to run through some kind of big picture items as far as, we talk a lot about fundamentals in the cattle market specifically. But one of the things that is, super important when you're looking at the markets in general is what's happening big picture as well. So what's happening in the economy, what's happening in the stock market. We've had a lot of headline news with the banking crisis, interest rates. Those are all things that can come into to the market and kind of affect price in general. We've had quite a few black swan events over the last few years. So although things do look really good right now, we're a firm believer that things can change quick, and we really don't know what the future holds, right? And that's why we use insurance, and that's why we protect inventory. So kind of looking at things big picture here for a minute on a macro data update. This is all just data that's pulled from Fred, just kind of looking at the economy in general and what people are doing with their money. Coming through COVID, obviously savings rates went way up. People were inside their house not doing much. Coming out of COVID, that number dropped very aggressively. So the savings rate today is at 4.6%, which is actually up a little bit off of our lows at 2.6%. But you can see well below our 5-year average. So, what this is saying is people are spending money, and that's great for the cattle producer. I mean, they're out there paying for that good product, paying for those nice steaks, paying for that choice product. They want to spend money. Maybe not the best thing for, the economy long term, but in the short term, this is a demand-driven market, and that's why these packers are bidding cash so aggressively. Disposable income, again, another factor of how aggressive people are able to spend money. That's another data point we watch, up about 8% year over year. And then obviously the big concern and what people have been talking about is CPI or inflation, up about 6% year over year. So everything is skewed to higher levels due to the current inflation environment we're in. Concerning things to kind of keep an eye on, when you look at credit card debt, up about 17% year over year. With rates going up and interest rates continuing to go up, that credit card APR, that interest rate at which people are borrowing money, continues to go up as well. Obviously, with built up credit card debt and increasing interest rates, that's a little scary long term. But again, I think with people wanting to spend money, go out, enjoy themselves, that's very good for the beef market as supports demand. Just another, basic point here, a home index report. So I'm sure a lot of people saw, the value of real estate increasing here over the last, 3 to 5 years substantially. Most recently, we have seen that tick down a little bit. So a lot of that probably has to do with interest rates going up and people not being able to borrow money as aggressively. But again, could be another indicator of, you can see back in 2008 and 2009, that was kind of the first indication of what turned a little bit. As home index started to move lower, prices started to decrease, concerns of a recession, start to become a little bit more relevant in the market. Equity markets have taken a big step back. Last year down pretty hard. Again, down another 10% year over year in the S&P 500. So again, doesn't seem to be slowing down people's spending, but you get a couple of months or years in a row of people losing money in their equity accounts and their houses losing value, they might not be so aggressive going out spending money on things like beef. Just something to keep an eye on going forward. Looking at box beef, so looking at demand from the packer side of things, again, cutout has stayed really firm. Obviously, in 2020, you can see there that big run up in boxes in May and June, and then, kind of coming off into July. That was throughout COVID, right? When demand was kind of going crazy, the plants were all shutting down, and, kind of I don't want to say irrelevant data point, but misleading data point. When you take that out and you look at where we're at today, boxes are still very, very strong, above $280 the past month, pushing towards 300. And, that's obviously a good thing for packers. If they can keep the boxes moving at elevated prices, they're going to be more incentivized to pay up for the cash. And that's kind of what we've seen over the last 2 weeks. You've seen box beef continue to run higher, like I said, pushing towards that 300 level. And, during that time, we've seen cash just continue to run up with it. So as long as they can move that meat on the back end, they're going to continue to be incentivized to pay up for product. Retail prices, again, continue to increase increase higher. All fresh beef retail prices increased 7.23. So the only time that's been higher was in 2022 when it was 7.28. So again, box beef and retail markets strong. Looking at cattle kills, we've actually seen a little bit of a slowdown in cattle slaughter. Again, when you look at the numbers relative to 2021 and 2022, we've seen this number start to decrease a little bit. And I think a lot of that just has to do with supply. Year-to-date beef production is down 2.6% versus 2022 and 1% versus 2021. So there's less supply on the market, less production being produced, and that's going to slow down the kills. This is the one kind of chart I'm going to finish with before we jump into the actual LRP product and look at insurance in general. But this is our gross packer margin chart. So just trying to take a look at, what's the profitability look like for the packers. And the reason we like to look at this is because if they're making money, they're going to be incentivized to, pay up and push that kind of profitability more towards the producer as well. This is looking at a gross packer margin. So you can see currently at about $300 a head. We don't know what their fixed costs are, but what you can see is their margins have been sliding substantially really since that peak during COVID. So as supplies tightened and demand has stayed strong, they've continued to pay up for cattle. The cash market, as I mentioned to start this, was telling you that market just continues to go higher. Throughout that time, what we've seen is, cutouts increased with it, but maybe not as aggressively as the cash. So they are losing a little bit of margin, which is a little bit concerning for producers. You can see there hasn't been a whole lot of time over the last 4 to 5 years where these margins have gone negative. So, the packers are going to do everything they can to kind of get cattle bought right. That's always the game that we're playing with, producers versus packers. But definitely want to watch this margin. If it starts to slide lower, that could kind of start to lead to maybe backing off on the cash market a little bit. All right, now the fun stuff. This is kind of why we're all here. So LRP. So this is kind of what we're looking at. I just wanted to kind of give you a little bit of fundamental data and information leading up to this conversation. I think you'll probably take away, a lot of the comments I made here the last 20 minutes are relatively friendly to the market, right? And there's a lot of good things happening in the cattle market today. It's hard to argue with that. And my job is to always play devil's advocate with producers, so I'm doing that every day. But and I'm not going to tell them where the market's going, but what we do know and what we've seen over the last 10 to 15 years is there's a lot that can happen, right? Nobody saw COVID coming. Nobody saw the fires in the plants happening. Nobody saw the extreme moves we saw in 14 into 15, and then the sell-offs that we saw into 16. We've just had a lot happen over the last 10 years, and the reality of it is the good times are great and the bad times are not that fun. But this product, can help kind of smooth the path a little bit for producers and allow you to, hopefully sleep a little better at night. So I'll run through how it works, and you will go from there. So LRP, basically just it's really true price protection. It ensures producers against declining market prices. It's just that simple. The live cattle LRP settles into the live cattle cash market, and the feeder cattle LRP settles into the feeder cattle index. I'll dive into that a little bit more in a couple of slides. There are daily offerings, so coverage is 13 to 52 weeks out. Coverage is updated daily. So every day new prices are released based on what's happening in the market, what's happening in the futures market. All these premiums, similar to PRF, are subsidized. so anywhere from 35 to 55% based on the coverage level that you're looking at. One nice thing about LRP in general is the premiums are not due until the end of the coverage. So free financing for the most part, you're putting coverage on today, and those premiums or those bills are not due until the end of your coverage. Especially with interest rates increasing, seeing a lot more interest in LRP just due to the fact that it costs money to, you're going to be charged interest to borrow money to put positions on. With this product, you don't have to worry about that. You're going to get charged at the end. You can choose, obviously, where your coverage is being placed, the length of it, and then the number of head that you'd like to insure. So a lot of pros, few cons, but a lot of pros. So, some of the main pros are the government does subsidize the program. The LRP premiums are subsidized. Like I said, there's a deferred cash flow component to this. You don't owe the premium until the end. You can choose specific coverage periods, no head minimums, and no margin calls. So if you're, a small cow, it doesn't matter how big you are. If you're a small cow-calf operator or a big feed yard, there's no minimum as to how many head you can insure. There is a max. I'll jump into that. But if you want to do one head, you can do one head. If you want to do 5 head, you can do 5 head. So unlike the exchange where, sometimes smaller numbers make it hard to work, with this you can do, as many or as little as you want up to the max. So some of the cons, just less flexibility than the exchange. You can't get out of this, right? So this is a true insurance product. A lot of clients when they put exchange positions on, whether it be futures or options, as the market moves, they might trade out of it. They might take the equity off the table, or they might do something on the exchange. With LRP, you can't get out of it. You can use the exchange with it to kind of adjust the position, but you can't really buy and sell it. Once you have it on, it's on. And then, like I said, there are limits to how many you can do. So you can insure up to 25,000 fed cattle and 25,000 feeder cattle per crop year. Crop years start July 1st and June 30th. And you can insure up to 12,000 head per endorsement. So those are the limits that come with the program. So how does the program work? If you wanted to do an endorsement, what does it look like? So RMA provides the quotes for the product on a daily basis. Like I said, they're usually released at the very latest by 4:30 Central Time, usually earlier than that, about 3:15 to 3:30. You would go in and you would decide, what coverage you want, how much it was going to cost you, and ultimately you would put the coverage in place. You would have to purchase the coverage by 9 a.m. Central Time the following morning, so that coverage is released in the afternoon. For example, today's coverage is good until tomorrow morning. Let's see if I can admit. Is good until tomorrow morning at 9 a.m. And that locks in your coverage price and length of time and number of head. After that 9 a.m. cutoff, prices are no longer available. You would have to wait till the following afternoon. Once that coverage ends, if your coverage price is greater than the ending value, there's an indemnity that is paid. So, like I said, the live cattle settles into the cash market. So if you're insuring cattle today, when your coverage ends, if that coverage that you put on is greater than the ending value or the ending cash market on your end date, you would be due an indemnity. Like I said, the ending values are based on the cash market or the CME feeder cattle index if you're using feeder cattle. And then ultimately at the end, you settle up. You either pay your premium if there's no indemnity, or if you're owed an indemnity, you would pay off your premium with your indemnity, and then if there's anything left, that would go back to you. All right, having a little technical difficulty here. So choosing coverage, how do you choose what you're looking at? So live cattle are pretty basic. There's only one classification. There's just live cattle, steers, and heifers. Coverage price and premium are determined by the RMA, and then the subsidy is applied to the premium. So end dates are every 30 days to allow you to try and line up with your marketings on a monthly basis. And then they're available from 13 to 52 weeks from your start date. So if you were looking at something today, you could go out 13 weeks, and then every 30 days the coverage is available up into 52 weeks. On feeder cattle, there's what they call a couple of classifications. So they break it down more by weight and by class of cattle. And they use what they call a price adjustment factor to adjust for pricing at those different classes, which I'll dive into a little bit here in a minute. So just to give you an example, you can see here we have an expected ending value, a coverage level, a coverage price, and I have highlighted here an end date and a coverage price. You can see we break it down by premium, which is right next to that coverage price, and then it shows your subsidy, and then it shows your net premium, which is what the producer would be paying. So that net premium number gives you your raw premium, takes your subsidy, and then that gets you to your net premium. So, for example, in this coverage that we're looking at here, this producer is looking at 1,000 head. That coverage price for October 13th, 10/13/2023, was at $159.70, and the net premium was $435 a hundredweight. So again, you can see there's an expecting ending value on the far left, which is how they price the insurance at $160.15. That's where they're expecting the coverage to end when it gets to October. That doesn't mean that's where it's going to be. That's where they're pricing the insurance off of. That gets you to your coverage price at $59.70. And then ultimately, as a producer, you pay that $435. This is where it gets a little confusing, and I don't want to make it more confusing than it is. What I would say is, to dig into this a little bit deeper, it would take a little bit of time. So I don't want to dig too far into it, because I think it's much easier than it seems. But what they use for the feeder cattle market is they use what they call a price adjustment factor, and what they do is, when you're trading cattle in the feeder cattle market, if you're looking at trading steers and you're looking at trading heifers, right? Most likely, and again, I'm not a cattle feeder, but I know that when you're trading heifers and you're trading steers, they're going to price them differently. A heifer is going to trade at a slight discount to a steer. So the price adjustment factor, is used to try and adjust the price of the coverage to reflect the actual market. So what they do is they've come up with a formula, and they take a percentage off of the steers to get you to reflect the heifer price. And again, it ultimately all settles into the CME feeder cattle index. Ultimately, what happens is, if you're looking at heifers and they trade at 90% of steers, let's say you had coverage on for steers at $1.80, those heifers would be priced at $162. So 90% of the steers is what you would be covering. And you would do the same math at the end of the day when the coverage expires. So once you get to that index, you would just take 90% of the index. I think it's best to show you an example, just because I know this slide, I debated even putting it in here. I think it's a little bit confusing, so don't let me confuse you. But let me just try and break it down a little bit easier. So if you're looking here for feeder cattle quotes, okay, so these would be the same quotes on the same day. If you had a group of steers and you had a group of heifers, example is for October 13th end date. The steers are priced at $219.56, and the net premium that they're showing is $622 a hundredweight. Very simple math, okay? To get your coverage on your heifers, you take 90% of $219.56. So as you scroll down here on the bottom, you can see your heifer price would be $197.60. So if you take 219.56 times 0.9, you get that 197.60. Same thing with the premium. It's just 90% of the premium. Again, it's kind of the same thing, right? You don't have to overthink it too much. It's just the way that they're going to validate the integrity of the program. They want to know if you're hedging heifers or steers, right? And they know that heifers are trading at a discount to steers, so that's the best way that they can come up with pricing it. Both the coverage price and the net premium are just going to be adjusted down 10%. Again, for the sake of this webinar, try not to overthink it too much. I can dig into this a little further, but it's not as confusing as it sounds. Live cattle. So talking about settlements real quick, how do we settle this insurance and what does it settle into? So the LRP settlement goes into the live cattle 5-area cash report in a bucket of 35 to 65% choice. So there's different buckets where the cash market trades, right? There's over 80%, there's total all grades. The LRP currently settles into the 35 to 65% choice bucket, which is for the most part going to be pretty close to the other buckets. There are times in the year where that bucket historically trades at a lower price than the total all grades. So what a lot of producers will see is when you look at the 35 to 65% choice bucket in those windows from May to August, you typically see the settlement at about $1 to $3 weaker or lower than the 5-area cash market, which is good for insurance because if you're trying to settle insurance, you want it to settle into the lowest price possible. So we watch these relationships. We look for kind of opportune times to use the LRP. Where do we think it's best? Where does it historically pay out? We're not going to solely base our decisions off of that because we're trying to protect risk, but it just helps when you're looking at kind of different strategies that you'd be looking to use. Feeder cattle settlement settles into the CME feeder cattle index. Again, there's going to be a basis component to that index. There's times where the CME feeder cattle index is historically lower than the futures, right? So if you can use a product that settles into a lower price than the futures market, it'd be advantageous. You can see typically in that June window right there, smack in the middle, that black dotted line is your average price. So you can see on average from May to August, there's a spread between the index and futures. So again, not going to be the only thing we use to make decisions, but want to be aware of it when you're placing coverage. Try and look for the most opportune spots to place that coverage if possible. Just wanted to give you a quick overview of some current offerings, again, and how we look at the curve. So this just shows you over time where you could go out and protect feeder cattle. Obviously, these prices are very, very high. That's just the nature of the market we're in right now. So again, as you go further out the curve, the concern is that the market continues to run higher. That's why we're continuing to see these prices. But you can go all the way out to January 24 and start locking in price. Same thing on the live cattle market. As you go further out the curve, prices look a little bit more attractive. So this gives you an idea of what floors you can look at for what type of costs or premiums. The last thing I want to run through, and I've only got 3 or 4 more slides, so bear with me here. We got about 5 or 10 more minutes. So we use the exchange in conjunction with LRP, not all the time and not for every client, but we do, use the two together. And I just wanted to run through kind of a basic idea that we would present to use against LRP. And really the only reason we would use a strategy like this where we're using the exchange in conjunction with LRP is when a client feels like, the insurance is still too expensive, right? So yes, the government program is subsidized and it is cheaper than using the exchange most times, but that doesn't mean that it's the right price for every client. So what we try and do is we use the exchange in conjunction with the LRP to help cut down the cost. Excuse me. Now, there's trade-offs to using the exchange with LRP. When you buy just outright LRP insurance, you have no cap to what you're doing. You have no obligation to sell. You have unlimited opportunity. Your max loss is always going to be just the premium you spent on the LRP. When you start mixing in the strategy I'm talking about, the reason we look at it is you cheapen up your initial cost. However, you have to be willing to give up some of your potential upside. So what I'll tell you is, in a market like we're in right now, in hindsight, anyone who would have sold a call option against their LRP would be most likely regretting it, because the market continues to go up and they want all that opportunity. So just kind of real quick here for just a basic idea. And again, if this is a little confusing, I just wanted to kind of present this idea just as a basic idea, but we can dig into it further. So just looking at what is a call option. A call option is when you buy a call or you go long a call, you're buying the right to be long futures at a specific price. When you sell a call, you're taking on an obligation to sell futures at a specific price. So again, big red note here, right? The only reason we would sell options or sell calls against your LRP is to cut down the cost. Because as a producer of any commodity or a producer of anything, you don't want obligations unless you have to take them on. There's no reason to have an obligation. The only reason you would do it would to cheapen up the cost of your initial coverage. So the example I'm showing here is the orange line is going to give you a clear picture of what your risk reward profile looks like if you just buy the LRP. So you buy the LRP for 164.32 coverage. It expires on October 5th. Your outlay or your max loss there or cost is $4.20 a hundredweight. You have no ceiling, right? So you can see as that market continues to run higher above 74, 76, 78, all the way up, you just have unlimited opportunity. Your only loss in that scenario is your $4.20 cost. What you'll notice about the next line here is that blue line, and that's looking at when you put LRP in conjunction with a sold call. And what you'll notice is your opportunity gets capped, and you have no participation to higher prices at that strike. So on the downside, what you'll notice is your floor is actually higher than just having the outright LRP. And the reason for that is because your outlay or your cost is less, right? So you're giving up some of that upside opportunity to cut down that cost and provide that higher floor. It's a trade-off. There's nothing free, right? Nothing's free in this world, unfortunately. But it's a give and take, right? So if 420 is too much, you can use a short call to offset some of that premium. But you have to be aware that if the market continues to go up and we continue to stay in this bull market, you're giving up, that top side. And one might ask, why would you ever do that? Well, the reality of it is the market doesn't always go up, right? So and there might be a point where a producer feels like they're willing to be short or they're willing to give up some of that opportunity. And that's the conversations we're having. At what point are you willing to give up that opportunity? And if it's never, then you can't sell the call. That's just the bottom line. You got to pay up. You got to pay the full $4.20 for it. One nice thing with the calls, if you were to sell calls and the market were to draw down, so this example is supposed to show you, you put that position on and the market does break. Instead of the market going up, you were to get a break. And in this specific example, we said the market was going to go down $10 over the course of the life of this position. And the beauty about selling calls is that you have the ability to get out of them. So, for example, here you can see if the market breaks $10, those calls that you sold to cheapen up your LRP would now be almost worthless, and you would have that credit in your pocket. Again, that's the idea with this position is you're keeping your costs down, you're increasing your floor, and if the market goes lower, you have less cost into your insurance, which ultimately gives you that higher floor. Give and take. that's really all I got for you guys. So, yeah, appreciate you jumping on here and listening to me here for the last 40, 45 minutes. And if anyone has any follow-up questions or concerns, obviously feel free we can either type them in now or reach out to me directly afterwards.
Thanks so much, Kevin. That was great. I mean, the analytics and stuff that you bring to the table are just, awesome. We don't eat, sleep, and breathe that like you folks do. So,
Absolutely.
So like Kevin said, anybody that has a question can ask it directly or put it in the chat. We'll give just a few minutes for those who are on to do that. I do have one question right now, just kind of from my standpoint. As you look at where the market is heading, and I guess the question is, how much temper do you think we should have in our expectations? I mean, there's always the risk of a black swan event, but a lot of folks are wanting LRP right now, and my conversation really is, well, that's fine, but this market seems to be continuing upward, so make sure you're willing and able to pay the premium. Where are we going, do you think? I mean, I know, pull out your crystal ball and
yeah so I mean, I think a lot of the and perfectly fair question, and that's my job, so I answer that question multiple times a day. And I kind of laugh because I'm not going to dodge your question, but I've been in markets long enough to know that they go up, they go down, and sometimes there's no reason for what they're doing. But I think right now, with the fundamental picture that we're looking at, there's no arguing. I mean, you can't argue the fundamentals. It's bullish. And the thing I'll say about that, and I'm a big believer in it, is I really believe a lot of times markets get ahead of fundamentals, right? So, I like to use the old saying, when everyone's on one side of the boat, you got to be careful, right? And I think we've had a really good run in this market. I mean, to see what's happened here the last 2 weeks, we've seen this cash market just absolutely explode to, prices that I've really never seen, and it's moved quickly and aggressively. We went through a time there where the cash market was steady. It was a good trade. It wasn't a bad trade. We were just kind of slowly grinding higher. They were putting $1 on it every week. But the last 2 weeks, I mean, it's just been explosive. Like, these packers need cattle, and they're paying for them. How long does that last? I mean, it's tough to say. I mean, the fundamentals and the supply situation it points to higher prices. But when you've got cattle trading $1.80 to $1.85, the only thing that concerns me is at some point you either price out the consumer, or you have a black swan event. You have something that makes this thing correct. And that's, just to give a quick recap of what I'm saying, is that's why, honestly, LRP has been a great tool. And I showed you that short call strategy just to give you an idea of kind of how we look at it. To be honest with you, like, we haven't been doing a lot of short calls. The LRP has been a great tool because you can put the floor underneath your inventory, and in reality, what you want is the market to keep going up. Just pay that $4 and go back to doing your thing and hope it keeps going up. And when the market's moving $15 in 2 weeks, $4 is $4, but $15 offsets that $4 pretty quick.
Yeah, that's been some of the conversation we've been having, is if you can't cover that in your operation at these prices, then we probably need to have a bigger discussion about how you're leveraged and you're operating, so.
Absolutely. And guys are always going to, I think you got to be aware of people's, emotions and personality. I mean, no one likes paying premiums. I don't like doing it for my insurance either, but it's just part of the deal.
Yeah. Well, great. Again, I haven't seen any questions come through, but again, thanks so much. And we just want to make sure everyone that's on and that watches this in the future, that you know that that Red Summit Advisors does do LRP. Talk to your agent. If we need to get some hedging and stuff involved, we'll certainly reach out to CIH to help us with that, I'm sure. But just again, thank you so much. Just the expertise that you brought to this is great.
Yep, absolutely.
All right, folks, we're going to go ahead and sign off now because I haven't seen any more questions come in. So everybody have a great night. Kevin, thanks again.
All righty. Yep. Thank you, guys.